I thought this is the sort of book that would appeal to those guys. And I actually read it on the plane on the way back from the Gold Coast when I got this. I thought I really enjoy the stories in it. If you like tales of the road, what it takes to be a geologist or an engineer out there in the back of nowhere with no help and no backup, this is a book for you. It'll give you a few laughs and a few insights into the heady days of mining exploration. It's called Rocks in Our Head. And there is a little stand just around the corner there. We can have a chat with Andrew and perhaps pick up some light reading for later on when you're sitting there with all the millions that you're about to make from our remaining 20 presenters today. So let's get underway, session number 2. Next up on stage is emerging Pilbara lithium explorer Global Lithium Resources. They're listed this year. They've been around for a little while as a private company though. They saw the opportunity to grow recently with the discovery of a greenfields exploration site, and their focal project is emerging as a very large and very fertile lithium project. James Wright is the fellow up here on stage with me. He is relatively new to the company. He's come on board at listing or just in prior to listing. Now, he is one of those ridiculously over-credentialed engineer people. He is, get this, an engineer, correct? He's also a geologist. He's also a university-educated financier. So he's got all 3 aspects to his belt. So he knows what he's talking about. And I was thinking when you took on that role of managing director, then you may be almost as important a discovery for Global as their little greenfields project they've got. So let's see what he has to bring to the table today. Would you please make him welcome?
Thank you very much for that kind welcome. Good morning, ladies and gentlemen. Hello to everybody who's web streaming today. We're really glad you can join us, even if it's virtually. I hope we're all charged after morning tea. It's a lithium joke just there. And I want to jump straight into it and talk about the exciting company that is Global Lithium and our growing Marble Bar Lithium project. We are in the Pilbara and we have a new discovery, the Archer Lithium deposit. The Pilbara is a great place to grow up as a lithium company, and we have a lot of growth ahead of us. Now, before I get into presentations, I like to start with a photo on the cover. Everyone has a photo, but this one is actually really interesting. For those of you who aren't mining orientated, what this is diamond drill core. This gives us a picture of what our deposit looks like. This is our Archer deposit. The interesting thing about lithium when it's in spodumene minerals is it fluoresces pink and orange under black light, disco lights. And what we can see in this diamond core is that we have very coarse bladed spodumene crystals that are fluorescing the right pink and the right orange. And that gives us a lot of confidence to go forward with our project. And we're really excited to see this with only our 2 diamond holes so far. And to have that sort of success so early in our listed life really puts us in good stead to take our project forward. And it's my pleasure to share that with you this morning. So sorry, there's a bit of a delay. Right, so our focus is to grow our Marble Bar Lithium project. We are located in arguably one of the richest infrastructure regions in the world when it comes to mining, the Pilbara. But more than that, the Pilbara is a Tier 1 lithium province and host to some of the world's largest lithium deposits, just around the corner from us. In the Pilbara, 100 kilometres is just around the corner. And so our project, the Marble Bar Lithium project, is remarkably similar, geologically speaking, to those 2 projects, Pilgangoora and Wodgina. We're in the same region, we're broadly the same age, we're in the same geological setting, and that is we are a hard rock, spodumene-bearing pegmatite ore body at surface within a greenstone granite contact. But more than that, the geological theory supports our comparison with respect to the source fluids for that being the split rock supersweet granite. And on top of that, all of these projects started life as a tin/tantalum deposit before migrating to lithium, just like ours. The difference between us and our peers is that we're still very early. We've only just really started to understand the size potential of our project and started to explore within our project area. Because when we bought this project a couple of years ago, we discovered Archer. So Archer is a new discovery. We drilled out the 10.5 million tonnes at 1% lithium oxide. It's a really good start. And it was really a catalyst for us to start to think, well, what's next? We looked around our project area and we've realised we have quite a large prospective area for us to explore. And we've only just really started to scratch the surface. Since listing a couple of months ago, we've already run 2 drilling campaigns and made an acquisition. We bought the tenement package to the immediate south of us, which more than doubled the project area for us to explore. It's a really key concept for us, which I'll get into later in the presentation. And to take our project forward and our company forward, we raised $10 million through an IPO. We had $8.6 million in the bank at 30 June, so we're well funded. And we've got a number of active programs going on right now to digest the work that we've already done, but also plan and be ready for our next drilling campaign, because we want to be back on the ground growing our project as early as October. And so from that perspective, we're looking forward to keeping the market updated with a lot of good news flow over the next few months. And we're doing that amongst a fantastic revolution, moving towards electric vehicles, household batteries. It's like an industrial revolution on steroids. And for those of you who heard Eddie Rigg's excellent presentation this morning, his keynote speech, the key thematic that I took from that presentation was, this is here to stay, and it's here to stay for a while. Now that puts us in a really good spot to grow with the market. What's relevant to us in this market is the spodumene concentrate price, because spodumene, should we discover an economic ore body and take that forward, is most likely what we're going to be producing. Since we started our IPO in January, spodumene prices have gone from $400 a tonne to $1,300 a tonne, more than 3 times increase. And market commentary suggests that we haven't seen the top, nor have we seen the extent to where this might take us through time. And we think that's really exciting for us, because as we grow our project, we get the opportunity to participate in this market as well. I'm so sorry. Oh yes, there we go. My apologies, ladies and gentlemen. There's a bit of a delay when I press the button. I'll try and preempt it a bit better. So in terms of who we are, at a glance, Global Lithium is in the name. We're a lithium exploration company. We've been around for about 3 years. Under the radar, we've been in Marble Bar for about 2 of those years, and we acquired our project as an exploration project and then taken it forward into the discovery and to what we see today. The company was formed by a group of people who had a long-term strategic view of the lithium market, including led by Dr. Chen, who's here with us today. We listed on the ASX because we felt that now was the right time to bring our project to market, and because we wanted to educate the lithium community as to who we are and where we're taking ourselves over the next little while. At today's prices, we're capitalised at around about $50 million, give or take, with about $8.6 million in the bank. So we like to think we're in a pretty good spot for growth going forward. It's a relatively clean structure, being a relatively new IPO. To talk a little bit about the people involved in our company, because I'm a big believer in people, and I think always talk about people before we get into the details of the project. My background is mining engineering, geology, and finance, but I've spent most of my career practicing none of those things. I've been spending most of my career in terms of developing projects and carrying them forward and helping them get to their next value point. And what attracted me to Global Lithium when I joined the company in February was its exceptional exploration upside and its enviable location with respect to logistics and infrastructure. And if I can leave you with 1 or 2 messages today, it's those 2 messages: exceptional upside, enviable access to infrastructure and services. Also on our board, Dr. Chen, founder of the company, very well regarded member of the mining community here in WA, and Warwick Hazeldine, our chair, who has a deep history in investor relations and advisory, particularly in the lithium space, has been involved in a number of the key lithium transactions over the last several years and brings a wealth of knowledge and expertise to our board. But perhaps most importantly of everyone on the screen there was we've recently appointed a new exploration manager, Brian Burke. Now, Brian's not here with us today because he's actually up on site advancing our project. But Brian was appointed a couple of weeks ago, and he actually led the Altura Pilgangoora lithium project from greenfields through to 40 million tonnes. So he comes with credibility, having been there and done this in the Pilbara before on a remarkably similar project. And for him to choose to join our company was an absolute extraordinary coup for us, and we couldn't be more excited to have him involved. And he's well supported by our external technical team, which includes Resource Potentials, who have a wealth of lithium experience in the Pilbara. So we've got a really good spread of skills supporting the company. Now, if I duck into the project details a little bit, and forgive me if I get too technical, I do tend to get into the geology, I think the key point I'd like to make about this slide is actually not around the text. In the diagram, I want you to look at the scale bar. That's a 5-kilometre scale bar. When we listed on the top group of tenements. We recently acquired the southern group of tenements. Now, what's exciting about this diagram and why I draw your attention to the scale bar is we have lithium in drill holes, lithium mineralisation, spodumene lithium, over 15 kilometres apart in the same system. So when we listed with Archer only a few months ago, and we had 10 million tonnes and we were wondering where do we go next and what do, we decided that we would start to step out because we had belief in the size of the system. And then we also saw prospectivity in the group of tenements to the south, and so we bought them. We bought them to show momentum in what we're doing and to show that we believe in that growth. And having such a large system for us is really exciting as we choose to grow Archer itself. Now, throughout our belt here, the 2 red dashed lines is really what we call our lithium Goldilocks zone. And that's a geological theory. It is very technical, but essentially it's the lithium highway that sort of is the right distance in the right rocks, the right space and the right age with respect to a whole bunch of things like the source fluids, source granites, prospective geology. So, but that's our highway. That's what we're exploring. And the area is very large. And we've only just really started to scratch the surface. If I zoom in a little bit now and talk more specifically about Archer, Archer comprises multiple spodumene-bearing pegmatite ore bodies at surface. You can walk across the top of most of these pegmatites, and from there you can kick the rocks and probably hit the main road that goes through our project site all the way through to Port Hedland. And look at some of the intersections that we had before we listed. 16 metres at 1.4% from 37 metres down. That's a really interesting intercept when you're looking at any sort of economic development. And that's at surface. I walked across the top of that pegmatite. So when we listed on the back of our mineral resource, but we've already been on the ground doing more drilling, which we haven't gone back to update our resource yet. In our more recent program, we hit intersections like 28 metres at 1.5% lithium oxide. And that's not true width, but my gosh, that's a really exciting hit for us. And so we're deep in planning at the moment to think about how do we take that forward and what other opportunities are around our project site. So sorry, it's a killer delay. Oops. That's right. I'll keep talking. If it flicks back, forgive me. Where I wanted to take the discussion is around where Archer goes and what it looks like in cross-section. Because for us, if you recall the earlier slide when we talked about source fluids and geology, the way we look at our cross-sections here for our pegmatites, they're shallow, they start at surface, they dip very gently back towards the east, back towards the sourced fluids, back towards that interpreted source geology. And you can see here, this slide's a bit of a before picture, and this is a bit of an after picture. So the before picture was the drilling that we used in the resource, but this picture is actually our recent drilling. This intersection here, the 28 metres at 1.5, is within a 50-metre pegmatite intercept. Not true width, because we had to angle it a little bit to get a better feel for the geology, but my gosh, is it exciting. It is as good, if not better, than all of the other intercepts that we've had on our project site so far. And it creates an opportunity for us to keep to grow Archer and see where it extends, whether it extends to the southeast, extends to the northwest, to the northeast, and then throughout our project area. And that's what I'd like to talk about now. And this is perhaps probably more exciting than even the deposit itself, is just the sheer scale of what we're working with. When we listed, we had a view that Archer was emerging as a large and fertile lithium system. And I'd like to say that we are demonstrating that with our programs. Our first program after listing, our maiden program on listing, has demonstrated lithium over a 6-kilometre strike length. And this was before we even bought our tenements to the south. We haven't even gone into there yet. But it's showing us that we are still seeing lithium with good grades near surface with outcropping pegmatites. So much so that when the guys were on site, and girls, my apologies, just to the bottom here, and I'll point to that, we're still finding new outcropping pegmatites after 2.5 years of being in the ground. That's exciting for us. And so to take that forward, we're looking at very new and novel areas. Oh my gosh, that was quick. To explore, and I'm going to skip over that only to say that we are planning to do an exploration program again this year, and we're deep in planning for that, which is why Brian is not here today. I'm going to blame the clicker for this, by the way.
What did the lithium-ion battery say to the zinc-carbon battery?
I'm sorry, you're going to have to repeat that.
What did the lithium-ion battery say to the zinc-carbon battery? Grab that other clicker while you're there. That one works better. You only live once.
That's
doing the dad jokes.
Thank you for saving me, by the way. I appreciate that. I'll skip some of these slides because I've only got a few minutes left. All right. I would like to spend time on this slide, though. This, to me, is probably the most exciting slide after our project, and this speaks to our enviable location. We are not a remote site, and for me, having been involved in bulk commodity projects and logistics-driven businesses for my career, cannot tell you how exciting it is to have a place that's 15 minutes drive from a town where we have 4 accommodation options. We have a pub, we have a service station, we have a general store, we have a post office, we have a community centre. It is just extraordinary to go up to site, have a beer at the pub, have a meal and get up the next day and then go to site 15 minutes drive away and to have access to a sealed airstrip. It is just an amazing location for us. And our site has a sealed road that carries quad road trains that are right now carrying iron ore, manganese, copper concentrate and other materials right through our project area, right the way through to Port Helen, one of the world's largest deep water ports that exports spodumene concentrate right now. It is a really good location for us. More than that, we've got a bore field on site. You're going to wrap me up, aren't you? Which I'll skip, but you're welcome to catch up with you after. And before we get too wrapped up here, I would like to just speak very quickly to this slide. Not because I want to show we're undervalued, but because we want to emulate the success of our peer group. But I will point out, because I am going to get the wrap up here, the collective market cap of this small group of lithium companies has increased by $1.5 billion in the last 6 weeks. But do you know what the contribution of Global Lithium was to that increase? 18 million. 1%. So for those of you who are looking at lithium companies, I would very much appreciate if you could consider us. And I'll leave it there for you.
I'm not allowed to talk technically until you finish clapping for the video out the back. Great presentation. Enjoyed that. Electric. Fabulous. Thank you so much. And apologies for that zinc carbon battery. That was disgusting. We need to check on our batteries out the back. Thank you so much, James and Global Lithium. And my girlfriend has just bought the hotel and the pub in Marble Bar, so I'll be having a chat with her very soon as well. Emma Bussell, keep an eye out for her. She's come across from Newman with the iron ore world. We're going to stay with lithium now, but we're going to move countries and continents. Europe is perhaps not one of the destinations that you would consider when talking mining projects, but the fact is it's got a really long history of mining, and today there is still very significant underdeveloped resources. And that is not going to be the fate, at least, of the largest hard rock lithium resource in Europe. It's being developed by our next presenters up here on stage, and that, of course, is European Metals. And heading the charge, can I welcome to the stage, please, Executive Chairman for European Metals, Mr. Keith Coghlan. Would you please put your hands together and make him welcome?
Thank you very much, Chrissy, and thank you all for your attendance. Thank you to Vertical Events for putting it on. Just to emulate the comments from a couple of speakers earlier, Eddie and Jamie just now, it is a very good time to be involved in lithium. The party's just getting started. I read an article from Thematica, which is one of the European-based green energy investment funds, and their statement was exactly that. Lithium-ion battery bonanza is just getting started. The metal is in deficit. It's going to continue to be in deficit for the foreseeable future, which obviously it will continue to have an impact on the share price. You know, Eddie mentioned earlier that the lithium price is up 100% over the last 12 months. That's true, but it's likely to go higher, and that's largely what's driving where we are, particularly in Europe, where our project is. The lithium space is, at the whole battery metal space, is a very fast-moving space, and just about every week we see significant development. So just in the last week, we've seen BMW announce placement of an order for $32 billion worth of batteries. We've seen Toyota commit to investing another $13.5 billion in their battery development and supply systems. Tesla's committed another $8 billion to building an EV battery factory next door to their Tesla gigafactory in Berlin, which, out of interest, is about 250 kilometres from our project. And that facility will be huge. It'll have 250 gigawatt hour capacity when it's completed. So, you know, this thematic does have a long way to go. Let me tell you a little bit about the project itself. And I will move through the slides fairly quickly, just a couple I want to particularly highlight. So important for us to just differentiate. Our project is a fully integrated one. That is, it's a mine, but it's also a processing plant. Our end product will be battery grade lithium carbonate and or battery grade lithium hydroxide. Just to differentiate, because here in Western Australia, we obviously hear a lot about the spodumene concentrate projects, all doing very, very well, but we will be going through the final end product of battery grade chemicals. It is the largest hard rock lithium resource in Europe, fourth largest hard rock lithium resource, or fourth largest non-brine resource in the world. What's important is it's by far the largest hard rock lithium resource in the EU. And that's an important distinction because there's an enormous commitment to this industry from the European Union itself. Project has compelling economics, after-tax NPV of 1.1 billion US, and an IRR also after tax of nearly 29%. The ability to produce battery-grade lithium hydroxide for less than $3,500 US a tonne, putting it very much in the bottom half of the global cost curve. The lithium hydroxide price today is about $18,500 a tonne, so you can see there's some significant potential margins there for us. We have some very strong partnerships. Our project level partner is the Czech national power utility, ČEZ, 13 billion euro market cap company, historically a coal miner and generator of electricity through burning coal, moving very much away from coal as the whole region is and into green energy. EIT Energy, another significant partner, is actually part of the European Union itself and the principal facilitator of the European Battery Alliance, and SMS, our German lead engineer. The project's fully funded to final investment decision expected about the middle of next year. And we have very strong ESG credentials, which I will touch on a bit more detail. The team we are building and have built there on the right-hand side, but we also have significant human resources in country. ČEZ employs in excess of 30,000 people. So, you know, we've got a lot of people on the ground over there developing this project. And I'm not sure which of these is the better one. There we go. So the European Union is all in on this thematic. They have been completely committed to an electric vehicle future, green energy future, battery industry, and more recently, the realisation that they need to develop their own critical raw materials to get anywhere near their own goals in respect of this. As it says there, they've made statements about wanting to be 80% lithium self-sufficient by 2025, which is a nice aspirational statement, but they'll get nowhere near that. There simply isn't enough lithium projects in development phase in Europe for them to get anywhere near that goal. But it's a clear aspiration. And, you know, the EU is not going to commit this sort of money to a new industry and be reliant on China or any other part of the world for a significant component of that supply chain. The uptake of EVs in Europe has been very strong. If I can get the clicker to work. Okay. These numbers are a little dated. I know the number for Germany now is 27%. It was 20.5 when we did this slide. And the total number of EVs expected to be built in the region over the coming years is demonstrated here. That's an enormous increase. So for my mind, the demand for lithium in Europe is going to grow quicker than anywhere else in the world. And that's because of these sorts of numbers. And it's a region that currently produces zero battery-grade lithium. I'm sorry about this clicker. There we go. Now, this is the anticipated undersupply in lithium hydroxide going forward. The last Macquarie research note I read this morning said that they expect lithium to be in perpetual deficit from now on. They also made the comment of imagine the price impact of a metal that's perpetually in deficit. And that's why we say that we think that this thematic is really only just getting started now. I mentioned that Cinovec was by far the largest hard rock deposit in the EU, and this slide just demonstrates that. So this is getting to be a very crowded map. I've been doing this presentation for some years now, and every time we rewrite it, we have to add numerous components to this particular map. So this shows battery factories in the region, constructed, in construction, or advanced planning. And Cinovec is about there, my shaky hand. So if you added together all the capacity of this and converted that to lithium demand, it equates to 125% of all the lithium produced in the world last year. So this is by 2030, this corner of the world, forget China, the rest of Asia, US, this corner of the world will require more than 100% of all the lithium produced in the world last year. Czech Republic, part of the EU, 2/3 of all of its exports go to Germany. So I'm just hurrying a bit in the interest of time. The infrastructure is in place. This is a historic mining area. So Cinovec itself is a historic tin mine. Tin's been mined here off and on for 600 years. They stopped mining when the wall came down at the end of 1989 because the tin price was only 5,000 US a tonne and it was not economic purely on tin. The tin price today is $34,000, $35,000 a tonne, and it's a very, very important byproduct credit for us. ESG. So I do want to talk a bit about ESG. This is becoming an increasingly important aspect of all mining projects globally, and that's for a number of reasons. Firstly, people want to think that they're doing the right thing wherever they can from an environmental point of view. The consciousness of that globally has increased dramatically. Secondly, of all of the investment funds available for us to tap into to try and build this project to fund it going forward, about 50% or about $30 trillion US has to pass some sort of ESG filter over every investment they make. If you don't tick the boxes on ESG, you're struggling to get your projects funded going forward. Thirdly, the people we will look to sell our lithium chemicals to are very focused on what the emissions profile of our product is. So when Volkswagen, for example, is assessed on the emission profile of one of their electric vehicles, they're assessed on every aspect of the supply chain. So if they can buy lithium from us that has a better ESG profile than from somewhere else in the world, that gives them an advantage. And obviously, Volkswagen in particular are very focused on emissions. So I'll talk about a couple of these points. So I mentioned earlier, it's a historic mine. So we're not breaking new ground. We're re-entering a historic underground mine. So significantly less impact on the environment, on the surface and on the community. Project has strong community support because it is a historical mine and historically a large employer in the region. We're proposing using solar-powered electricity. Our partner, as I said, is the Czech National Power Utility. So if anyone can deliver us solar power by the time the project starts up, they can, and that's certainly their intention. But what is also important is that we are very, very close to our end users. So lithium that currently gets into Europe comes from either here in Australia or from South America. And you can imagine, without going into that in any great detail, what that journey looks like and what sort of CO2 footprint that journey might have. So we expect to be shipping end product or trucking end product, say, no more than 250 kilometres. And that in itself obviously helps our costs, but it also assists in our CO2 output and therefore our overall ESG credentials. I mentioned our strategic partners. I won't go into each of these slides in any great detail. Chairs the National Power Utility, the EIT, which is part of the European Union itself, and the European Union is very focused on getting projects like ours to production. And the SMS Group, very large German engineering firm with excellent global credentials. The PFS, I mentioned the headline numbers of that in the opening slide, but just interesting to note that these numbers were done 2 years ago based on $12,000 a tonne for lithium hydroxide. As I said to you, it's about $18,500 today. The difference in that is about $300 million a year in lithium revenue over at least the 21 years that's been modelled here. So that makes a significant impact, obviously. Where we are in our development. So what we have to do going forward, we're in our definitive feasibility study, looking to conclude that end of first quarter of next year and move to final investment decision. We believe the project will be eminently fundable. Those conversations about funding the project going forward are beginning now. If that all falls into place, we'll begin construction towards the back half of next year and look to be delivering our first product into the European market in 2024. The slide I showed earlier about the upkick in production of EVs in the region has 2025 as being a significant uptick in numbers of EVs produced in the EU. So a 2024 production timeline fits very nicely with that. As I said earlier, the project holds a very, very large lithium resource. The PFS that we developed utilises less than 10% of that overall resource. So we will shortly embark on a study to explore the feasibility of significantly increasing production. And all of these things are, I think, significant developments for us going forward. The other key thing that we want to bed down before too long will be offtake agreements. Anyone who follows the space has seen what sort of impact that has on the fortunes of companies once they bed down offtake agreements. It's fair to say that this is becoming a seller's market, and offtake discussions are taking, or have been taking, a favourable turn for people like us. Buyers are all of a sudden starting to talk about things like offering floor prices for long-term contracts, even if the contract itself is still at market. I've seen a couple announced now with floor prices involved. We didn't see that not so long ago. And, I think it's going to continue. We're going to see a squeeze. We're going to see buyers becoming more and more interested in taking offtake, particularly given the overall credentials of the project. The board and team that we put together, as I said, this is augmented by our partners who employ a significant number of people in country with a very, very long history of dealing within the Czech Republic. And that goes to things like permitting, liaison with the community, liaison with the government, et cetera, et cetera. So, we've seen permitting become an issue for a number of projects in Europe in all sorts of metals or commodities. It is a green centre globally. Although there's a long mining history, there's not a lot of recent mining history in this sort of region. And so permitting will continue to be a focus for, I think, all European projects. We feel very comfortable about our permitting for the reasons I've already said. We're re-entering a historic mine. We have the Czech government as our project level partner, etc., and the credentials of the project overall are very beneficial to us. This is an abridged version of our presentation. I've gone through it pretty quickly. Please, if you're interested, feel free to have a look at the website and contact me at any time if you want to know more information. Thank you very much.
Thank you, Keith Coughlin, and thank you to European Metals. Like that, the party's just getting started. Metals and deficit prices are still up. Am I allowed to tell one more lithium joke while our next man comes up? Go on, let me. Lithium walks into the bar. He's been there the night before. It's been a bit of a hard night. And he walks up to the bar and he speaks to the bartender. He said, "I think I left some electrons in here last night." The bartender goes, "Mate, are you positive?" "Oh, shoot, I told the whole thing. Hold on." He said, "Are you sure?" He said, "Yes, I'm positive." I was so pleased with the end of that joke too. I ruined it. Let's leave those dad jokes to the dad. Some of you are more qualified than me. All right, this next folk here. He's not talking lithium. No, he's not talking lithium. This is Jeremy Robson, Managing Director of RareX. Now, RareX is focused on developing rare earth deposits in Australia, including in Cummins Range Rare Earths Project, which is in the East Kimberley here in WA. So he's going to give us an insight into the investment potential of RareX. Jeremy is a Managing Director. He's an experienced mining executive. He's held senior roles at Mungana Gold Mines Limited, Apex Minerals Limited. Would you please make him welcome?
All right, thanks very much for that introduction, and thanks to Stewie and the team for putting this conference on again. Very well attended by the looks of it, and I'm here to tell you about RareX and rare earths. We spent the last two hearing about lithium. Rare earths is the other essential suite of metals that are essential for the decarbonisation of the world, specifically used for their properties in magnets and EVs and wind turbines, etc. We think we've got a pretty good project on our hands at Cummins Range here in Australia in a very safe jurisdiction, and we look forward to continuing to develop it and bring it forward to production to support what's going on in the world at the moment. So yeah, I probably mentioned most of this just then, but our flagship project is the Cummins Range project. We're located in the Kimberley region of Western Australia. We're pretty proud of the resource we put out this year, 18 million tonnes at 1.2. Including a high-grade portion in there of about 2% TREO, which is to the correct side of the graph in terms of grade, and we'll talk to that in a minute. Exploration is back underway. We got off to a slow start this year, just with drill rig availability. It's always hard enough in the Kimberley convincing drillers to go up there, but it's even harder when there's a drilling boom going on, an exploration boom, but we're finally away and delivering results. We put out the first bunch of assays this morning, which were well received, and yeah, we continue to drill right through to Christmas this year. Rare earth prices, you heard about lithium prices are up 200%. I think rare earth prices are up 100%. They're over the magical $70 a kilo, which is where we really need them all to be in this industry. And lastly, I'll advertise our upcoming spin-out, Cosmos Exploration Limited. But fundamentally, I'll continue to talk about rare earths and what we're doing with our project. So obviously listed on the ASX, a few shares on issue, well funded for what we're doing this year with $6.5 million in cash and shares. Still a very modest market cap of around 45 million compared to some of the other rare earth companies around. They're about a year or two ahead of us, so we think we've got a fair bit of valuation gap to catch up as we move forward. The board is worth talking about. Some very well-credentialed people on that board. You heard about lithium earlier. Well, John Young knows a fair bit about lithium. He was involved in Pilbara Minerals from the very early get-go, and he can see what's happening in rare earths as well. So he's agreed to join us and is a very good guidance to me. Cameron Henry there as well, founder of Primero Group, now under NRW, building the concentrator at Mount Holland on the lithium front. So understands these industrial minerals and metals and brings the processing expertise that we need as we push this project forward. Worth mentioning that we've appointed a general manager projects this year to push forward our feasibility study, and that's really freed up a bit of my time to get back to this, and he's going to really push this project forward as quick as we can now, because we think the time is now to develop a rare earths project. So the rare earths market, fundamentally you're talking about the magnet metals when you talk about rare earths these days. Lanthanum and cerium have become almost junk metals. They're just in such overproduction. You're talking about neodymium, praseodymium in the lights, and dysprosium and terbium in the heavies. They're the four metals that will pay your way in the rare earths business and probably drive 90 to 95% of our revenue going forward. And why are these metals useful? They're useful in magnets. Very useful in EVs, electric cars. You need very powerful motors to drive the engines, and you see the growth in EVs is on the up and up. You hear about it every day. Also in wind turbines for wind power, especially in offshore wind. You need these really high powerful magnets. You don't want to be out there every day or two servicing them. So these are the two main growth areas in rare earths, and this is just going to be a story for this decade and beyond. So you heard about the structural deficit in the lithium market. It's very much present in the rare earths market. You overlay that with probably 90% of rare earths still coming out of China. So you've got the structural deficit, you've got a renewed focus on supply chains outside of China. You're seeing lots of government investment in places that can deliver these rare earths to market. And Australia is one of those places, North America is one of those places. But we're seeing increasing focus from governments to fund our projects as well. And I talked about the price. You can see the price at the moment is over about $90 a kilo for NdPr. So that's a very good price for rare earths. I think last time round there was a shock in the rare earths market. It got to $280 a kilo. So $90 might not be definitely won't be the end of it. I see some forecasters talking 120 to 150 in the short term on NdPr. So into the detail of our project. We're in the Kimberley region, just south of Halls Creek. I think you've got the Browns Range project, another rare earth project, the other side of the highway. Lots of gold mines and nickel mines and whatnot in the region. Well provisioned for infrastructure. Far enough out of the way that you're not going to annoy people when you go mining, but close enough to get things done. And as we know, West Australia is a Tier 1 jurisdiction for mining. ESG, I'm working towards having a full slide on ESG, but at the moment it's just a dot point. We released our ESG framework this week, and we are committed to what we've set out in that framework. You can go to our website and have a look at that, but it's all about us doing the correct by all our partners and the environment, economic, social and governance. So the resource we put out about a couple of months ago now, that was based on the drilling from last year. What I'd like to draw your attention to is the higher grade portion of this. It was very much my focus coming into this project was to not try and drill out a 1.1% ore body, but it was to drill out a 2% ore body. And we've done that. We've delivered a portion at a 1 grade cut, 1% cut. We've got 6.5 at 2% rare earths and about 0.2 niobium as well. Niobium can be a very important byproduct for us. We're assessing how to recover it at the moment, but look, niobium is not uncommon in carbonatites and it's the primary source of niobium worldwide, so we're expecting to get value for that too. I should point out here the NdPr content of our resource is about 21%, so that compares favourably to most of the rare earth companies. If you're mining monazite, it's 15 to 25% in an NdPr content. There are some exceptions, I acknowledge, but for example, Mount Weld is about 24%, so we sit pretty close to that, and that's where we want to be. And just to put the grade into context, obviously Mount Weld is the freak, running 5.4% globally. I think when they started the mine, it was about 12%, but it's come back as they've got through the good stuff. So we sit third of the left there. We think I'm very much focused on finding 2% material here. I think that's where you need to be to make these projects work. And the drilling we're doing at the moment is proving that we can do that. So what is the project? The geology, just quickly, it's a carbonatite project. It's similar to Mount Weld. It's not exactly the same, but it's got a lot of similar qualities. The rare earth is in the monazite mineral. So what we noticed when we came into this project, that we suspected the drilling was in the wrong direction. It was just set depth drilling on a north-south line. And we picked that up in our drilling last year, and this year we're coming back and drilling it in the correct direction, and we're getting the results, the true width sort of intercepts that we expected. It's highlighted a bunch of features in the resource to us, mainly these northwest-southeast ending trending structures that seem to control the high grade. And that's very much been proven to us in the drilling we're doing at the moment. We've done our initial phase of RC drilling. We've released the first bunch of assays today, and we're probably about halfway through our scheduled diamond drilling, but I dare say we'll extend the diamond drilling on the back of what we're seeing at the moment. So this is the initial results we put out this morning from the RC drilling. I just wanted to put this in. It shows, this is the number we had this morning, about 40 metres at 2.4%. So we think there's about a 40 metre wide fault trending through this deposit. It's running over 2% rare earths. It's running attendant niobium. We can track it over at least 500. It may stretch to a kilometre. And it's only really been tested in the oxide portion of the resource to date, because that was the theory that you needed the weathering process to generate these things. And that has been a contributing factor to the grade. But what we're seeing in the primary now is we can see the primary source, and it is just an extension of the oxide portion. So this is what I mean by that. This is the vertical long projections along the main fault. Oops, sorry, I'll go back. So this is what it looks like in the oxide. It's a breccia. It's got high-grade rare earths and niobium. This is an oxide breccia. This is the first proof of the primary. It just looks like that, but weathered. This pinky oranging stuff is massive monazite, massive rare earths. It's massive here and it's distributed throughout the rest of this intersection. The breccia zone here was about 40 to 50 metres wide, and the bottom 20 metres of it were primary sulphide. So that gives us encouragement to keep drilling, both completing the rest of these holes and continuing to drill it down dip. And that should grow our resource. We've got that 6 million tonnes in the oxide portion there at about 2%, so we expect to add another 5+ million tonnes per 100 vertical metres. And for those of you wondering, are there underground rare earth mines around the world? Yes, there are. There's been historic ones in South Africa, and there's no reason that you can't do these things in that fashion, just as you're seeing the lithium industry move partially to underground mining as well. So our commercialisation strategy, initially when I came here to set this company up, it was a strategy of producing concentrate and selling that to existing capacity. And more specifically, all that capacity resided in China and Southeast Asia. This is a rapidly evolving space. There's people building refineries proposed within Australia, within North America, within Europe. So we're assessing our supply chains. We're seeing how our supply chains integrate into our ESG framework and our ESG strategy. So we're slowly unpacking our strategy, considering how the market's evolved, and also with the growth of our resource as well. It may be an opportunity for us to go further downstream in terms of making rare earth carbonate and extracting further value before we move our product on. So look, that's the rare earth story. Just quickly, I should advertise Cosmos Exploration. This is our spin out. It's focused on nickel, copper, gold. The two projects that come with this company is the Burrow East. It's an extension of the Western Gneiss terrain. So we're looking for Julimar analogues up there. Appreciate it's a long way from Julimar, but that belt is extensive. It's just on the edge of the Yilgarn Craton. Desert Metals is having some success with magmatic nickel sulfides in that part of the world, and just got to find something with scale and grade in it, and we'll give it a go there. Also, our Orange East project in New South Wales, right near Orange, right near Cadia East, so that'll be a porphyry, copper gold, and also a McPhillamy style target for us. So we're setting that up at the moment to list next month, raising 5 million. Only on a modest 2 million EV, so a slightly different way to do things. And yeah, we're excited by what that company could bring. RareX will retain a almost 30% shareholding and a free carry in the Orange East project. So look, that's us quickly. We're a rare earth company. We're focused on rare earths. We very much believe in the thematic. I think everyone in the room probably does. That's why you're here. We've announced our resource. We're very proud of the resource we put out on the back of drilling last year. We're back drilling again, so you can expect another resource upgrade next year, and you can expect ongoing assays for the rest of the year, like the ones we've put out, explaining to people what the primary mineralisation and the potential there is. We think it's quite large. Rare earth prices are where they need to be. I expect them to keep going. You've seen the lithium price go up 200%. Rare earths has only done 100% so far, so maybe it can go again. And as I mentioned at the end, Cosmos Exploration, if you're interested in nickel copper exploration, that's a good one to watch. And thanks very much for listening to the story.
Jeremy, thank you very much. Jeremy presenting on behalf of Rare Earth. Our next presenter on the stage, or our next company at least at New World Metals 2021, is a familiar one to those of you who've attended any of Stewie's conferences, Altech Chemicals. They're an ASX-listed mineral and chemical processing company focused on the development of high-purity alumina and the production operation. HPA is a rapidly growing market. They're driven by an increased demand from LED lighting, computer chip manufacturers and sapphire glass from the electronics industry, and Altech is aiming to become the world's leading supplier. And this fellow up here is the powerhouse behind it. Could you please welcome Iggy Tan?
Good morning, everyone. My name is Iggy Tan. I've come from the lithium industry. As some of you would know, I was the founding managing director of Galaxy Resources, and I built the Mount Cattlin project and the Jiangsu lithium project, and also acquired all the assets of Lithium One. I remember starting at Galaxy, the market cap was 5 million, and recently Galaxy merged with Orocobre, valued at $2 billion. What I want to do is talk about the future of lithium-ion batteries. And I guess Tesla is setting the future of lithium-ion batteries. And the recent battery day, they announced 3 terawatts of battery capacity they want to build. They also launched their 4680 cells, which is 46 millimeter diameter and 80 meter long, 5 times more power, 6 times more energy. And they also announced they want more silicon in their lithium batteries. And I'll talk a bit about why that is so important. I know some of you will understand the lithium battery, but just to explain what it does on the first charge, and this is really a fundamental problem of lithium batteries today. When you charge a lithium battery, all the lithium ions go from the cathode side to the anode side. And as the battery gets charged, and when you discharge the battery, all the lithium ions go back the other way. What people don't understand is that about 10% of the lithium stays on the anode, and it becomes inactive to the battery. So imagine before the customer even gets a battery, 10% of your lithium ions gets locked up and becomes inactive. And this is a big problem for the industry. Well, what's happening is that the first cycle loss is due to the lithium being absorbed around the graphite particles. It forms an SEI layer, all right? It becomes inactive. And during the life of the battery, the SEI layer cracks and it exposes more sites that lithium gets absorbed on. And the other issue is also hydrofluoric ions, which is in the electrolytes, break down the SEI layer, exposes more sites and more lithium is absorbed. And that's why you see a degradation of lithium in the performance of the battery. So this is a big problem. So why is HPA or alumina coating the answer to this problem? Well, there's a lot of research that's around. Our company hasn't done the research. A lot of research have shown that it helps with the first cycle loss. It increases the life of the battery, and it improves the safety of the battery as well, alumina coatings. So this is an example of a study that's done. They show together, this is a coated graphite versus a non-coated graphite. Now, after 200 cycles, you can see the higher energy density of the coated graphite. I mentioned about safety. Well, what they did was, this is an example of a nail penetration test. So they use a nail and puncture a hole in the battery on the left-hand side. It's a non-coated graphite battery. Temperature rises and you get thermal runaway. You can see the picture of the battery. On the right-hand side is a coated graphite, gets to 90 degrees and virtually stops. So coating the graphite also helps with the safety of the battery. Now, there are 3 ways to coat graphite, alumina onto graphite: the vapor method, the solid methods, and the liquid method. And the vapor method is using atomic layers, very expensive process. The solid methods is putting powder around the graphite, but we use the liquid method. Essentially, we coat the graphite particles with a liquid, and then we calcine in situ. We make alumina in situ, and that provides a very uniform coating. At 2 nanometers, okay? A nanometer is a millionth of a millimeter. So your red blood cell is about 10,000 nanometers. So we're talking about very thin layers of alumina. And what it does, it stops forming that SEI layer and resolves this first cycle loss. But it doesn't stop lithium from going through it, so it doesn't stop the performance of the battery. Remember I talked about the hydrofluoric ions? Well, research shows that alumina absorbs hydrofluoric ions and converts it to an inert material. So it solves another problem. And this is what we think will happen if we can resolve this problem, is that the life of the battery increases. So you see the red line, the life of the battery increases. We've done this in the laboratory. This is our particle on the left-hand side with a very thin layer of alumina, that white layer. And we've now taken it through our battery testing. So we have our own test facilities. We've now created these graphite-coated material and we've put it into batteries. And it's fair to say it's looking very positive. Very stable batteries at the moment with graphite coating. All right, let's talk about silicon. Silicon is the anode material of the future. It's got 10 times the energy capacity than graphite. So something like 3,500 milliamps per gram versus graphite of 372. So for a layperson, it's just got more sites that the lithium can sit on. So if it's that good, why isn't silicon in our batteries today? Basically, there are three problems. The first problem is that silicon expands 300% in volume and it fractures. The second problem is that it has a very high first cycle loss. So instead of 10%, it's more like 50% because there's more sites that it can absorb lithium on. And thirdly, it's got a very high fade and so on. So what is the potential if we can get silicon in our batteries? That's what Tesla says. We need silicon in our batteries. Here is a graphite material. If you add 10% of silicon, the energy density goes up to 693, nearly doubles the energy density. You add another 20%, it triples and so on. You can see the potential benefit of getting this right. I mentioned the high fade. If you add silicon today and you don't do something to it, it actually makes your battery less efficient and less life. So you've got to resolve this problem. I mentioned that 300% volume expansion. So on lithiation, the silicon particle expands 300% and it fractures. Well, this is under the microscope, you can actually see this fracturing process of this silicon particle. Now, the industry, and what happens if you're trying to put it into a battery and it starts to fracture, you actually get delamination. So you actually, a lot of swell and it starts to lose contact with the copper plate. That's not what you want for a battery. All right. So what the industry has been doing is saying they try it at larger particles. 1 micron, half a micron, it still fractures. And what they find is that if you can get down to 115 nanometers, a very small particle, the volume expansion doesn't create fracture. So that's great, but there are two problems. The costs of getting to 150 nanometers, very high costs in milling, and also the first cycle loss is even higher because of the surface ratio to volume ratio. So those are the two big problems. And we believe that our alumina coating will contain that fracture in the battery. And what we're working on is a particle size around the half a micron material, which brings the operating costs. There is an exponential change in operating costs. And because we have the coating, it'll resolve in virtually resolving the first cycle loss capacity. For a very exciting stage, we've now coated our silicon in the laboratory. We've now taken it to batteries, and it's fair to say it looks very promising. So essentially what we will do is we'll coat graphite material, coat silicon material, put it together as an anode material, and sell it to the industry. And this is what we're aiming for, 30% silicon in graphite and coated graphite. Now, I'll give you an example. If we can do 30% silicon in graphite, it's probably worth $30 a kilogram. And our plant that we're going to build in Germany, or the pre-feasibility studies, are 10,000 ton per annum plant. So immediately that's nearly 300 million in revenue. Now, what does it mean for the end user? This is a Model 3. It generally travels around the single charge about 470 Ks. If you can add 10% silicon in it, on the single charge, it goes up to 680 Ks. 20% silicon, it goes to 940 Ks, and 30% up to 1,100 Ks on a single charge. So it shows the potential of silicon, and that's why Elon Musk said, we will get silicon in our lithium-ion batteries. Now, Most likely, the car manufacturers is not going to give you 1,000 Ks. They'll keep it at the 423, but it reduces the weight of the car because the batteries need to come down. So 10% silicon will save 16 kilos, 20%, 23 kilos, and 30% up to 27 kilos, which is a big deal for electric vehicles. I mentioned my PFS in Germany. We want to build a 10,000 ton per annum materials coating plant situated in Saxony in Germany. And we have now the site that we acquired or an option to purchase. We have some warehouses and development facilities. And we also have some great partners. SGL Carbon, one of the largest graphite producers in Europe, with a collaboration agreement with them. And Ferroglobe, one of the largest silicon producers in the world. We also recently signed up 2 NDAs with 2 top German automakers, very interested in our technology. All right, why are we focused in Europe? Essentially, the story of the lithium-ion battery will be Europe in the next decade. It has been about China, Japan, and Korea. It's now about Europe. Why? As the previous speakers had mentioned, essentially, through EU regulations, all the car manufacturers have announced they will go all electric by either 2025 or 2030. Previous speakers have also announced how to support it. Something like 600 gigawatts of battery capacity has been announced in Europe. Companies like CATL, Tesla, etc. So this is the potential demand of that material. So if we can supply some of that material into the end user, we hopefully will be very successful. Thank you.
As always, informative. Thank you so much, Iggy. That was very interesting indeed. Silicon. Right, going back to the lithium that you're talking about, and actually we're going to stay in Europe. You suggested the name of the country of Germany to us, and we're kind of focusing there with our next presenter. So lithium, we're not looking at the start of the process here. We're going to the end of the cycle. What to do with the tsunami of those batteries that Iggy was talking about? It's a question that was considered by this fellow here, Chris Reed, and Neometals a number of years ago, at which point Neometals pivoted. They moved from exploration and production to the other end of the chain. They're now building the leading lithium battery recycling plant in the world. 2 reasons they're doing this, and one of them is, of course, financial. I'm going to let Chris fill in what the other one is and see if it's something that you want to be on board with. Would you please welcome Chris Reed, MD from Neometals.
Thank you very much, Chrissy. Thanks to Vertical Vents for putting this on and Argonaut for stepping up and sponsoring it. I'm going to tell you today about Neometals and what we're achieving by spending $2 million a month developing the greenest battery materials in the world. So we're an innovative project developer. We've moved away from mining. We've pivoted toward eco-friendly materials recovery and recycling as a business model. The common intersect of our 3 main projects is that they're exposed to commodities most positively impacted in the trend, the mega trend towards EVs and stationary energy storage. The 2 main projects that I'll cover today, big focus on the EU. We've got a fantastic team with a growing record of delivering some successes. We've future-proofed the balance sheet through the development of Mount Marion sale, of that sale of our offtake rights. We picked up about 230 million. We've returned about 87 million back to the shareholders. We've invested 60 million into the business, and we've got a very healthy balance sheet at the moment. And so, you know, we're very fortunate. We've got 6 inside the portfolio of these 2 projects. We've got 5 of the 6 most positively impacted commodities that are going to benefit from the EV. One we'll touch on today is the lithium battery recycling project that we have in Germany in a joint venture. The vanadium recovery project up in Finland, that's in joint venture. In terms of the corporate dashboard, we've been getting some love, which is good. The stock's up about 500% in the last 12 months, which is Mobile Man, as the biggest shareholder, pretty happy. So, the backdrop. this is nothing new to most of you. So there's going to be more EVs, right? We've got it. All the major car makers in the world have committed to going electric. What we don't understand, or that very not really well known, is that these cars have twice the carbon footprint as an internal combustion engine. So if we swapped over right now, we would have this huge injection of carbon into the atmosphere. And we've got to address that. And why is there the big shock? The big shock is because they've got batteries, and these battery supply chains, the minerals that we mine have got really carbon intense footprints. So we're looking to address that. So if we're going to make a ton of batteries out of raw materials, you know, spodumene from Australia, converted to chemicals in China, shipped around the world, DRC cobalt shipped around the world, you know, nickel from various parts of the world, you know, it's not great for the environment. So we're going to have to increase the amount that we recycle. There is a lot of production scrap. About 10% of what goes into these batteries comes out as production scrap, and then we've got a plan to recycle it at the end of life. The main recyclers just smelt it now. Umicore, Glencore, they basically just smelt the batteries. You lose the graphite, you lose the electrolyte, you use the plastics. We've developed a hydromet, right? I mean, Australians are pretty good at hydromet. So we think we can get down to 200 to 300 kilograms per tonne of batteries. So we decided to set up an incorporated joint venture targeting initial development in Europe. We've got a 50-50 joint venture with a company called SMS Group. You would have heard Cogs talk about them as their leading engineering partner for European Metals. So we're aiming to be the recycler of choice for the cell makers and car makers around the globe. We're studying two sizes of plants, a 20,000 tonne plant or 50 tonne a day. That takes a production scrap, which is about 10% at steady state. When they start these battery plants, and no one's made batteries in these sort of volumes, it's 20 to 30%. And then we're also studying a 200,000 tonne plant to capture the 90% that make it out of the factory and into the cars. So essentially what we've done is, you know, rather than smelting base metals, we've come up with a hydromet process that basically builds on solvent extraction that was pioneered out at Mount Isa. And to basically handle these batteries, if I've got a tonne of NMC 811 batteries, which will be the predominant EV cathode chemistry, it's like having a tonne of ore in front of a concentrator that's got 15% nickel, 15% copper, 2% cobalt, and 2% lithium, right? You cannot lose money. So that's why we've designed a process to handle it. It's a patented process. Essentially, we take the batteries, we shred them safely because, you know, they've still got charge in them. We physically remove the plastics, the steel casings, the aluminium and copper sheet. We then got a black mass, which is a mixture of the graphite and the cathode materials. We put that into a sulfuric acid and we use solvent extraction to sequentially strip it out. And we're left with ammonium sulfate as a tailings, right? So we're not putting anything into the atmosphere. We're not ejecting any water into the environment, and our only tailings is a high quality fertilizer. So it's a very, very clean process. Just with the solvent extraction, we've produced cathode spec material, no ion exchange cleanup at this stage, but we will put that into the full plant, and we're at 85% recycling efficiency. To build one of these 50 tonne a day or 20,000 tonne plants, about $165 million swing. That's US. The most important thing, operating costs, about $1,560 per tonne of cells fed in there. To put that into perspective, if you've got your laptop or your phone batteries, they're lithium cobaltate, right? There's about 11 or 12,000 bucks worth of recovered value in that, and it costs us about $1,560 to process it. There's less cobalt, obviously, in the car batteries. They're more nickel, right? I mean, essentially, it's a nickel plant. And so we get down to 811. At these prices, it's about $5,500 of recovered value. So plenty of headroom. What does that mean? It means that basically we'll be the greenest, lowest cost nickel producer in the world. But the main products clearly are nickel, cobalt, lithium. That's about 85% of your basket of goods. While we're focused in Europe, like Iggy said, it is the second largest battery production hub outside of China, right? It's massive. And Germany within that is the biggest market and has the best car makers. Apologies, well, not really, but they do. So hence our demonstration plant is in Hilkenbach. And look, if they've got the batteries, they're going to generate the waste. So the blue bit is the production scrap, and the green is the end-of-life batteries. We model about 8 years for the effective life. And if you don't believe me, I drive an electric car, mine will be knackered in 8 years. And the new battery regulations, this is going to be passed in the next couple of months. This will set the standard. California and the EU will set the regulations, and we will have to adhere to those here one day. So we're already future-proofed in terms that we can already surpass all of their recycling efficiencies. Everyone here, every company presenting here, if you want to get into the battery supply chain, you need to know what your carbon footprint is. If you don't know what your carbon footprint is, you cannot sell to car makers. So you need to do a life cycle analysis, you need to start off, and you need to get into that. So, the delivery for this, SMS Group, 150-year-old German engineering company, one of the biggest plant builders in the world, 14,500 employees in 95 sites. They will take what has been a fantastic R&D success in Australia. We've been into this for about 5 years, and they will build plants for every car maker and every cell maker wherever they need, whenever they need them. So, we're really, really happy that we've got them as a 50-50 partner. We are co-funding this fantastic demonstration plant. In fact, 2 weeks ago, we decided to bring forward our development plans and start industrial scale operations at this very site. Can you please start that video, Shane? So, invented in Australia, engineered in Germany. Hilkenbach, where it's located, is their manufacturing headquarters. They've got 4,500 bodies on that site. So this is the 3D model. The plant's in 2 stages. So we put the batteries into stage 1, which is the shredder. Think of this as the crusher, right? So we spray on a liquid. We've got an inert atmosphere because these batteries still have a bit of charge. We designed it for sort of 30% charge or less, but we have been shredding up to 90% charge batteries. And so the material, the coarse material, the plastics, the steel casings, aluminium foil, copper foil goes up, the black mass goes down. We then separate some of that physical product so that we can reuse it again. The black mass, no beneficiation circuit's perfect, so some of that stuff leaks into the black mass. We then pump that over to a filter press. The fine material goes straight into a leach feed tank. The coarse material will filter off. That's still got some payables in it. So what we'll do is we'll then take the filtered material, we take them over to the vacuum dryer, we recover the lithium electrolyte. We then take that black mass, we mill it again, put it through some screens and send the fine material over to the other side of the plant, which is the hydromet refinery. We'll get over there in a second. And so essentially what we do is we've got 3 feed storage tanks, which are closest to us down the bottom right. That then goes into 5 leaching circuits. The graphite won't actually digest in the sulfuric acid, so we can filter that out, which is great. We then take out the copper first. We then sparge in ammonia gas and we drop the aluminium and iron out as hydroxide, so that can go back to a refinery. There'll still be a little bit of copper hanging around, so we've got to rip that out again. We then take out the cobalt, the manganese, the nickel, and the lithium last, and then we're left with an ammonium sulfate. And so that's what it looks like in the design. That's what it looks like in reality, right? I mean, you could eat off the floor here. These Germans are very, very precise. So in terms of the timeline to build our first 20,000 tonne plant, we're just about to start commissioning, wet commissioning the refinery circuit, start the trials in October, finish them in November, complete the engineering cost study in December, complete the feasibility and final investment decision in March 2022. And look, we've got some flexible business models, right? Because this is a new pioneering industry. As principle, we can either go and buy these little laptop batteries because they've got so much value, or we'll actually start charging for a fee. So the car makers are coming to us. We've got car makers who've given us all the feed for the trials at the moment. We've actually made a decision to start commercial operations at a 10 tonne a day rate in the March quarter. We've also done some MOUs for partnerships because the big game is to get the end of life vehicles, right? The 200,000, plus size plants. And for the really big guys, we're not going to cut our nose off to spite our face. We will license it to them. So what we've done is announced that we're going to increase the capacity of the demonstration plant up to 10 tonnes a day. So we've committed to that. We've also done MOUs with the Steel Company of Canada. Essentially, they're a big steel maker. They use scrap end-of-life cars for the electric arc furnaces. More of them have got batteries. So we've done a joint venture to put a hub and spoke, so we can put a number of shredding spokes and ship the black mass to a large hydromet facility. We've also done an MOU with Itochu, who actually, despite being a commodity trader, deeply ingrained into the supply chain. For batteries, they make their own stationary energy storage batteries. So we are demonstrating a commitment that we do want to be, well, probably not the first, want to be the biggest and best. The second project is a vanadium recovery project that we're earning into 50%. So there's an unlisted company called Critical Metals. We're the largest shareholder. They've been based in terms of their operations up in Sweden for about 10 years. We've secured a contract to buy 2 million tonnes of the highest vanadium grade bearing steel slags that have been stockpiled at 3 of their mills. So we've developed a process. You know, what we've done is we've developed the battery recycling process, and we've developed a very eco-friendly process to recover this vanadium. We're licensing that into the joint venture. We're actually capturing CO2 from emissions, sparging it into water, so like a supercharged soda water, carbonic acid, and recovering the vanadium. That's where it's located. What does that give me? A minute, does it, Chrissy? Yeah, right. So anyway, we've piloted this. It's sort of a negative carbon footprint. And we've actually had a battery maker use our vanadium in lithium vanadium cathodes, which is a chemistry that you're going to hear a lot more about. It's the ultimate chemistry in terms of energy density. And the Volkswagen guys are trialing nickel vanadium manganese batteries at the moment. So I'll go skip past that one. I mean, you know, what do I want our Neometals shareholders to feel? One, I want them to feel secure, right? We've got lots of cash. We've got a fantastic business model. We stick to it. We make money. We return it back. And we've got fantastic opportunities, right? We're producing a number of critical battery materials. They're green. They've got the lowest carbon footprint. They'll be either the lowest cost or in the lowest quartile. And we've got some fantastic partners that can actually deliver the success. So thank you very much.
Chris, thanks. Yes, I got myself distracted because I was actually so interested in what you were saying. Iggy, I noticed your eyes just watching that one too. There's a lot of interesting things to consider as we go down this renewable energies path. We've got not a live cross, excuse me, but I was just trying to work out our logistics as well. Our pre-record has come in, hasn't it, guys, from Sydney? So we've got all that stuff ready to go. Okay, so obviously our next presenter, if you look at your programs for today, is a fellow called Harry Fisher. Harry is a senior consultant at CRU International, and he is based in Sydney. So he has managed to get his pre-record done and he sent it across to us. It runs for 19 minutes 30. The topic of this conversation is battery metals, and he's going to present an overview of them to us here at the conference. So I'm sure it's going to be interesting. Would you put your hands together, please? And welcome Harry Fisher virtually.
Hello, everybody. My name is Harry Fisher, and I'm a senior analyst at CRU. I'm in the battery metals team, focusing on cobalt primarily, but also battery metals demand in general, as well as being in charge of CRU's electric vehicle forecasting. I'm based in Sydney, so unfortunately can't be with you today in Perth, which is a real shame. But hopefully you enjoy my presentation, and if you have any questions, please do get in touch. Just a quick introduction to CRU. We're an international mining, metals and fertilizer business intelligence organization with a consulting division for bespoke assignments, an analysis division for subscription market analysis products, as well as an events business organizing conferences and other events. If you have any questions about CRU, our battery metals work, or anything else, please let me know. So today I'll take you through the following agenda and really dive into potential risk for battery metals demand in the medium to long term, and that will hopefully be particularly relevant for those of you at the conference today. who are thinking about nickel and lithium and cobalt specifically. So I'll start off with a quick update on our EV forecast and what's happening in the market. I'll then move on to the cathode chemistries and the importance in electric vehicles and importance to those metal markets. I'll then look at some potential risks to that demand and the relevance to those chemistries, and then wrap up with some key takeaways at the end. So first, EVs. 2020 was really a turning point for electric vehicles. We saw really strong year-on-year growth despite everything else that was going on at the start of the pandemic, and this really bucked the trend of the broader auto market. We saw strong year-on-year sales growth for electric vehicles, including both battery electric and plug-in hybrids, and that equated to 37% year-on-year growth. Europe did briefly become the largest EV market globally, ahead of China, but that will change going forwards. But it's really 2020 where we're seeing even stronger growth, and that's going to be even faster at 75% year on year. China will easily be the largest market, more than doubling year on year. But we're still seeing very strong growth in Europe, and importantly, we're now seeing growth from North America and primarily in the US as well. So this really continues the momentum and continues the strong trend for electric vehicle sales growth that we're seeing globally. And importantly, it's now all three of these major markets that are driving strong sales growth. This chart shows the historical performance for the three major markets. You can see China in the dark lines kind of being a little bit volatile in the past, depending on the level of subsidies that are in place. Sales grew very strongly in 2017 when subsidies were introduced, but then pulled back as subsidies were wound back. And that was really because electric vehicles were still a lot more expensive than combustion engines at that stage. We've seen a real rush in EV sales in China in the last year or so, and mostly recently that's due to lower cost models that are kind of in the 5,000 to 10,000 Australian dollar range, so that they're very affordable. In Europe, in the light blue line, we've seen it quite slow up to 2019, but really drive since then. And subsidies have been really key in Europe over the last kind of 6 to 12 months. We've seen strong subsidies in a number of the major economies, and that's driven very strong sales growth over that period. And in the green line, the US has kind of trundled along at the bottom for many years, and EV sales actually declined year on year in 2019 and 2020. But it has really turned a corner in the last 6 to 9 months, and that's down to primarily big commitments from the auto producers in the US to electric vehicles, and that's meant better model availability and choice, but also supportive policy as well from the Biden administration. Now we're starting to see real momentum from all of these key automotive markets. And the chart on the right here shows how China and Europe have really been driving this up to now over the last 5 years. But going forwards, we're still seeing very strong average sales growth in all of these markets. And it's really North America where we're seeing some catch up in that market and helping drive global sales. So this shows our overall view of the automotive market over the next 5 years, with the line showing the share of electric vehicles over that period. So last year, EVs accounted for about 4% of the global market, and that's rising quickly to 7% this year. And that will reach about 15% or around 15 million vehicles by 2025. And that's annual sales. And it's really kind of between now and 2025 and into the late 2020s where the trend will really start to accelerate. And that's because electric vehicles will reach cost parity, with internal combustion engines, and that will enable enable them to become a lot more competitive with combustion engines and really start to eat into the larger automotive market. And as I said, the important thing now is we're seeing strong EV sales growth year on year, not just in China, not just in Europe, but also in the US, and that's enabling these very fast growth rates. So now I've provided some context of the EV forecast, I'll move on to cathodes. So those who are less familiar with electric vehicle batteries and lithium-ion batteries in general, they're split into a cathode and an anode. The cathode is really where all the magic happens, and that's what often people talk about, as it really impacts the performance of the battery, the cost, the safety, and those cathode chemistries generally use nickel, manganese, cobalt, and lithium. Those are kind of the core metals in these cathode chemistries. And I'll talk mostly about nickel, cobalt, and lithium today, as I think that'll be most interest to the audience. So the preference for the cathode chemistry in electric vehicles comes down to a number of factors. Of course, cost is one. The electric vehicle battery makes up a large proportion of the overall vehicle cost. So the cost of the cathode is very important to control that cost and enable them to be affordable to consumers. The energy density and performance is again critical because it affects the range of the car, which at the moment range anxiety is a concern for some consumers. So that's very important. The higher the energy density, the longer the range in kilometers. And the performance for some of the higher end vehicles like the Tesla Model S that've got very high performance statistics. That's also important to consider. Raw material sourcing as well. Some of these markets, such as cobalt, have more complicated supply chains and some issues that people are trying to work around. So that's another factor in some of these choices for technology. And of course, safety. As we move through this electric vehicle transition, the safety of these vehicles is critical and is a big factor in people's choice. So if we look at the average cathode share for battery electric vehicles in 2020 for the major markets, you can see that it varies quite a lot. I've categorized this into LFP, so that's lithium iron phosphate, a number of high nickel chemistries, a number of medium nickel chemistries, and then some others. So in Western Europe, you can see that medium nickel, the likes of NMC 532 and 622 have really dominated. They've got kind of reasonably good energy density, are reasonably affordable, and a trusted technology. In China, LFP has really dominated due to its low cost, due to the lack of nickel and cobalt in those chemistries. And then the medium nickel has got higher energy density, so higher range, has accompanied LFP in China. In North America, due to the dominance of Tesla at the moment, NCA, or nickel cobalt aluminium, is really their cathode chemistry of choice, and that's why there's such a dominant share of NCA in North America at the moment. But going forwards, that will change quite substantially, as you can see here on the right. You can see a much higher share of the high nickel chemistry, so that's the nickel manganese cobalt 721 or 811, which has got higher energy density, higher performance and range. And then LFP will remain strong due to its cost benefits, and will really suit many people that live in cities that aren't so concerned about very long ranges of their vehicles. So in the long term, we're seeing really the dominance of the high nickel NMC chemistries and NCMA, and also LFP due to its lower cost. And it's important to consider kind of the different preferences across regions, not just these major markets, but other countries and regions too, due to their preferences for distance of travel or cost or a number of factors. On the left, I've compared some of the major chemistries So LFP versus some of the high nickel chemistries, and you can see some of those factors and how they change. Energy density is, of course, better for the high nickel chemistries, but they're not so. They have had some issues with safety in the past. They're higher cost, and they also contain cobalt compared to LFP, which has its issues due to price volatility, some supply chain concerns, etc. So those are some of the considerations that some of the automakers and battery producers are going through at the moment, is finding kind of the best blend of these chemistries. So this is our overall global average view in the longer term. You can see a variety of the NMC chemistries shown in blues and greens, with the higher nickels in greens. And it's really high nickel in LFP, as I said, that dominates in the long term. We're seeing a shift away from some of the medium energy density NMC cathodes, and NCA will eventually be phased out globally on average as well. So it's high nickel in LFP that are expected to dominate over the long term. So that will be supportive of nickel demand, cobalt demand as well, and of course lithium. So the final part of my presentation kind of we'll touch on what I've just gone through, but kind of look at some of the risks to battery metals demand in the long term, and that's directly related to those cathode chemistries. How could some of those shares change, and how much of an impact could that have on the outlook for the demand for these markets? So for an average electric vehicle with a 50 kilowatt-hour battery, such as a Nissan Leaf, this shows the metal content in the cathode for the major metals. As I said, I've touched on lithium, nickel, and cobalt mostly today, but manganese is also in there for NMC. You can see in yellow that the lithium content remains relatively steady between all of these chemistries, between kind of 20 to 30 kilograms. So it's less sensitive to the individual cathode chemistry, which is good news for lithium demand. But you can see nickel and cobalt does vary as you get a higher nickel intensity from left to right. You've got a higher nickel proportion, of course, but the amount of cobalt does reduce. That there is an offset to that to stability, because the cobalt does help with the stability of the cathode, but it also does help bring down the cost of the cathode too. So these are some of the considerations that for the next couple of slides. And really, why am I focusing so much on electric vehicles? It's because it really makes up the bulk of the battery markets in the long term. You can see the share of total 2030 battery demand for these markets. Nickel and lithium, it really dominates, and it does to a certain extent in cobalt too. So that's why understanding electric vehicles and understanding some of these cathode chemistries is really important for the long-term outlook for these markets. So what I've done is I've investigated a few different scenarios around these cathode chemistries, just to show how sensitive the demand forecasts are to the shares of each. So I've looked at 3 different scenarios. The first is our base case, which is the same as what I showed on the previous slides. The LFP share will be about a quarter of the overall market in 2030, and those high nickel chemistries will account for about 63% of the market. The second scenario is kind of similar to what's happening this year, so it's kind of a 2021 status quo, assuming no major changes. Again, LFP maintains about a quarter of the market, but you can see that high nickel share is a lot lower. High nickel has had some safety issues in the past, and those are kind of being worked through at the moment and trying to improve the stability, so that this scenario kind of assumes that medium nickel remains more dominant. And the final scenario is really the opposite, where high nickel becomes even more dominant. LFP drops a little bit, but it's that high nickel share that increases more, which is positive for nickel demand, but a bit less positive for cobalt demand. So bearing in mind those three scenarios, this slide shows the results on total battery demand growth from now to 2030 in compound annual growth rate terms. So I'll come back to lithium and nickel, but you can see for cobalt, there's kind of a real disparity here between the three different scenarios. So in the base case, we're assuming about 12% average growth over this period. In the high nickel scenario, it's slightly lower because those chemistries are less cobalt intensive. But in the high LFP and medium nickel, due to the higher cobalt intensity, we've got much stronger growth over that period for cobalt. And it's really cobalt that changes quite a bit between these chemistries, as I touched on earlier on, compared to lithium, which is relatively steady. And you can see that because of that, we're not seeing a huge change in that demand, that demand growth over this time period. In the base case, it's 19%. It's slightly lower in the high nickel scenario and slightly higher in the high LFP scenario. So you can see lithium's not quite as sensitive to these scenarios. And as expected, nickel in a high nickel scenario has got slightly faster growth, but again, not drastic. And similarly for the medium nickel, that drops the nickel intensity slightly. So you can see the different drivers of these markets depending on those scenario choices, and shifts in these cathode shares, and those shares are expected to change quite a lot from now through to 2030. Can make quite a big difference to the demand prospects for these markets. So I'll wrap up with some key takeaways before you get off for your lunch. So EV sales were strong in 2020. That was very clear, and we saw really strong growth in China and in Europe. But 2021 will be even stronger. We're seeing continued momentum, and importantly, we're now seeing that from all of China, Europe, and North America. That's really driving the EV transition on a global scale. Those cathode chemistries are changing rapidly. We've seen a lot of shift in the last year or two, and I'm sure we will over the next couple of years. So it's understanding those cathode chemistries is really key for these demand markets, for these battery demand markets, and thinking about how that will impact the prospects for lithium, nickel, and cobalt in particular. And as those scenarios showed, lithium demand is fairly resilient due to its kind of similar intensity in these chemistries. But nickel and cobalt can be a bit more susceptible, and it'll be really interesting to see how the preferences for those cathode chemistries changes over the next few years. Thank you very much for listening.
Harry Fisher, Senior Consultant, CRU. Thank you, Harry Fisher. Thank you, everyone. I think you're already moving. You're on your way. We're going to go and have a lunch break for half an hour, and we'll be back in here. And for those of you who are feeling a tad cold, I'm onto it. We've already got the hotel management looking at what's happening with the air conditioning in this room. We want you to be super comfortable. Enjoy, everyone.